Moving from one conversation from a corporate voice to another, Nitin Rakesh is the CEO at Mphasis, and we've also got Manish Dugar, the CFO, joining in to chat a little bit more about their numbers. Good to have you on board, gentlemen. Nitin, to begin with, as you promised, it seems like growth has bottomed out. We did see the marginal gains kick in this quarter. Going forward, do you believe that growth will accelerate?
Yeah, I think if you think about the components of the business that were a little bit under revenue pressure for the last few quarters, I think we are seeing stability in most of those segments. There is still uncertainty in BFS, which obviously is the largest part of our business. But we do believe, based on at least the recent trends, there is some stability starting to emerge there. Still a seasonally challenged quarter, so we'll have to watch how that goes. But the other two segments, I think between mortgage business, we saw the pace of decline really coming off sharply last quarter. And we called with that fact that we are at or near the bottom. They're purely based on the order book and the market share gains. It seems like we should be able to see sequential growth. And we've seen stability in DXC already. So purely based on the order book and the wallet share, status of accounts bottoms up, it looks like we should be able to see sequential growth, in the next 2 quarters.
Sure. Nitin, and this sequential growth would be despite the higher Q3 furloughs that your peers have been guiding as well, you think?
Yeah, I think some of that uncertainty still exists, especially in the BFS segment, as I called out. But given the fact that in the first half of the year, we've had 920 million of TCV wins, kind of a record for H1. Last quarter, obviously, was a big win quarter, being Q1. That also helps build the revenue base from an order book perspective for the rest of the year. So I think we're cautiously optimistic that we should see a return to growth. Acceleration of growth might happen, in the subsequent quarter, but definitely things are looking like they're bottoming out.
So Manish, give us a sense as to what the outlook is when it comes to the margin walkthrough. Do you stick by your 15.2 to 16.25% margin guidance, or are you revising it?
The philosophy has been in making sure that we remain within a sustained margin of 15.25 to 16.25 for the year while investing for growth. There are puts and takes. We have opportunities of investing, and at the same time, there are savings, that we have been able to accrue because of productivity gains, fresher mix, and so on. So as long as we are able to make sure that there is a focus on operating efficiencies, and there is a focus on making sure some of these operating levers are maximized, there is enough tailwind that we see, which gives us confidence to maintain the margin in that range while investing for growth. We had called out that we are, reasonably confident of maintaining, if not significantly expanding, and we have been expanding the margin by 0.1% for at least the last 3 quarters. This specific quarter, again, revenue has been flat, and we are hoping as growth comes back, that itself will give us some opportunity for upside. But having said that, despite the last few quarters of revenue sequential decline, we have been able to manage the profitability. And given we are now getting revenue to bottom out, it only gives us an ability to either maintain, if not further expand from where we are.
Right. Nitin, your deal wins, though, have slipped sequentially, and understandably because of the high base. What's the range that we should work with going forward, and which segments you think would contribute to deal wins given your diversification push?
Yeah, I think if you think about the nature of large deals is they're lumpy. We had an exceptional quarter last quarter. The good news is pipeline is still up 26% YOY. So our ability to continue to originate deals, is showing up in the pipeline. Obviously, every deal goes through a sales cycle. And given that we converted a very large number of deals last quarter, a record in terms of both number of large deals and TCV, I think it was bound to have an impact on the closure stage of deals. So as we build up the deal flow through the pipe over Q2, Q3, you'll actually see this number kind of revert to where we think the average is. And the average has been inching higher pretty much every year, for the last 5 years. So I wouldn't read too much into just the the Q2 number itself, but I think if you look at the first half performance, it's actually significantly higher than first half of last year by over 50%. So I mean, the right way to think about it is trailing 12 months, and that I think from that perspective we are well positioned. If I then look at the shape of the pipeline and the deal wins, I think the wins have been fairly broad-based across verticals. They're not led by any one vertical. Non-BFS, both in terms of pipeline, has expanded very significantly, over 50%. Even BFS pipeline is up 25-26% YOY. Wins-wise, I think there's a pretty equal distribution, both in terms of Q1 and Q2. So I think it's a pretty broad-based view of both the pipeline as well as the TCV wins, and we're very pleased with the fact that while we're not deprioritizing BFS at all, because that's our home vertical, we have a right to win there. We continue to actually make sure that the diversification outside of that gives us new engines of growth, and that execution strategy has been working very well for the last few quarters.
Right. Manish, what about the headcount? Because there has been a slip sequentially. Do you think that this trend will continue?
As a philosophy, we actually have a continuous process of comp revisions through our GQ score and Talent Next platform. And hence, we don't have the once in a year comp increase that comes and hits the P&L. So it's a continuous process, and it happened last quarter. It will happen. It happened this quarter, and it will happen in the next quarter as well. From a headcount perspective, a large part of our headcount is dependent on utilization, and as you know, we have been working very hard to make sure our fresher engine starts kicking in. And as that kicks in, utilization improvement leads to ability to deliver revenue within the existing headcount. We have had a slight reduction in the overall headcount. However, from a productivity and a pricing perspective, and given deals are largely driven by outcomes, which does not necessarily have an impact of headcount, we have had not any significant increase in the headcount as the revenue has moved. But as revenues come back and as we start seeing growth, utilization can give us only so much. We will have some improvement possibility in the utilization. However, beyond that, it will eventually have to be supplemented with increased headcount. So, a lot of it depends on how the macro plays and how the revenues turn out to be. And as Nitin said, while we will see sequential growth, but we expect the growth acceleration, maybe Q4 onwards. And when that happens, we will have a better visibility of how the headcount plan will work out.
Right. Nitin, lastly, FY25 will be a year of inflection and turnaround for you after bottoming out in FY24. Would that be a fair assumption then?
Yeah, I think it's hard to call FY25 given the level of uncertainty on the macro front. This higher for longer narrative, the ability to see any improvement in volumes when it comes to things like mortgages, discretionary spend and budgets for next year, capital markets are still frozen. So I think it's very hard to call what happens, 6 months from now. At this point in time, given the uncertain macro, I think our focus really has been on the micro, which is go account by account, vertical by vertical, geography by geography, and start building out those order books that give us the visibility. Because the most dangerous thing in business is to call a bottom before you actually have certainty on it. So I think we are right now very focused on bottoms up approach versus trying to take a top down macro view. As we get closer to the next year budgeting cycle becoming visible in Jan-Feb timeframe, we'll probably get a better idea to give a guidance for FY25.
All right. Thank you so much, gentlemen, for joining in and giving us a perspective on the quarterly performance as well as the road ahead for Mphasis. That's the management saying that, yes, there is uncertainty about the extent of the Q3 furloughs, but the focus is going to be on efficiency as well as utilization, and the deal wins have been fairly robust. The pipeline looks strong. That's the stock price, though, down about 1.5% for Mphasis. But let's move